друзья, добро пожаловать на третий день зимней школы. Он сегодня особый. Во-первых, он открытый. Мы никогда его еще не делали таким открытым. Пришли не только участники, те, кто изначально записывались на зимнюю школу, но также те, кто просто узнали о мероприятии. Мы вас всех приветствуем и начнем. У нас сегодня экспериментальный день. Мы не знаем, что это получится. Мы пригласили людей, которые находятся не просто на стыке науки и искусства, а находятся даже, скорее даже ближе к стороне искусства. И для чего мы это сделали? Мы хотим понять, мы хотим разобраться, как устроен мир. И искусство, и наука, и религия, они все пытаются найти правду. То есть понять, как мы устроены и почему все происходит так, как происходит. И, конечно, мы как-то находимся в сфере интересов школы, поэтому начнем с крестовой торговли, с роботов, которые сейчас формируют финансовые рынки современные. Вот. И я поэтому хотел пригласить участников первой лаборатории, лаборатория Trading&Risk, Вячеслава Арбузова, прогноз Risk Lab. Анна Кристин Ланг, как из школы. Евгений Васин, Constellation. И Михайлова, психолог, композитор и финансовый менеджер.
Ну и в качестве такого предисловия, которое нас погрузило бы в атмосферу техники, искусства, хотелось бы посмотреть следующее видео.
Always had a good beat. You could dance to it, even if sometimes you danced off a cliff. A century ago, the traders moved to the dots and dashes of the telegraph. Over the years, technology sped up the market's tempo. By the Roaring 20s, there were tens of thousands of telephones on Wall Street, and the beat picked up. By the end of the 1960s, stock tickers reported information twice as fast and were fully automatic. By the 1990s, investors could get prices in real time, and electronic trading began to dominate the market. In 2004, an electronic exchange could trade a stock for you in about 7 seconds. Computer networks and algorithms got so fast that human players were pushed aside. The beat of high-frequency trading is now measured in milliseconds. This new music now accounts for half of all trades in the US. Advocates say the technology has made investing cheaper for everybody. Though a lot of people worry that these super fast new computer programs could take advantage of the rest of us, and that a momentary glitch could cause a tremendous crash. With high-frequency trading, few humans will make the cut on Dancing with the Stocks.
Это вот было такое вступление, чтобы задать тон нашей сессии. Сейчас с докладом выступит Анна Кристина Ланг.
Thank you. So I have to say that I cannot really comment on what you just said because I don't speak Russian, but I think it was a very, very nice aesthetic visualization of high-frequency trading, which I'm going to talk about a little bit in relation to my research on crowd dynamics and the financial markets. So as you see from this picture, there has been a development in the financial markets recently that has been happening quite fast. And so when people ask me, how do you understand market psychology and crowd dynamics to influence the financial markets, it doesn't make sense anymore. Before, when we had traders trading face-to-face in the open outcry, pick, you could see that they would actually trade from being associated with one another. They would use psychology to actually talk to one another, and if one guy would be buying something, for instance, the other guy would follow him also buying because they would trust him, and people, if they were selling, they would be afraid, and then they saw that a guy that they trust would be selling, so they would also be selling. So price moves were actually influenced by social behavior, and that is quite clear, and that has been studied a lot by sociologists. Then we saw a change where traders, they were trading in front of the screen, manually executing their trades by clicking on the mouse. And still you could see that in the trading room, the sociality and the psychology between the traders would actually affect price moves because they would be situated in the same room and they would actually affect one another. Now we see that traders, they are pre-programming their algorithms to automatically execute trades, which means that the human being are actually not making the decision in front of the screen as such, buying or selling a specific financial product. So people, they will tell me, so now the human is actually out of the game, and we cannot talk about psychology in the financial markets anymore, so the human biases would actually be eliminated now, and the financial markets have become a lot more efficient. But I have to say, trained as a sociologist, I am still quite fascinated by this rather counterintuitive question. Does market psychology still influence the financial markets? And I would say yes, it does, and that's what I will talk a little bit about in this presentation. So the aim of my research project, which is based at Copenhagen Business School, is to understand how, why, and what consequences ideas from crowd psychology have been deployed to understand and make sense of financial markets. So I'm first going to introduce a little bit about how crowd dynamics has been seen to influence the financial markets. Then I will explain how I'm going to study this, the methods and the data, and then I will introduce the high-frequency trading debate a little bit also, because it is a quite controversial issue, as we also heard yesterday, and as they said just in the film now. And then I will show a little bit about the data that I have collected and how I approach this from a sociological perspective. And then I will pose some questions for further debate. So just first to define what is crowd dynamics actually and crowd psychology. It is actually a scholarly field of its own that people, they are disciplined within. It emerged in the late 19th century, and it argues that people are actually mentally transformed when they become part of a crowd. So if you imagine taking part of a football game or seeing a piece of art, you are being emotionally affected by the crowd, by being a part of a group of people that you would not otherwise be. So we also had Alexei presenting this, making a point about suggestibility and the way that we are actually being affected by our emotions. So crowds is usually understood as being irrational, they are contagious, they are de-individualizing entities, where people, they blindly imitate the hypnotizing leader. If you think about revolutions, for instance, the crowd would follow a leader and you would somehow subject yourself to the emotions of the crowd and not be rationally thinking for yourself anymore. So this is what the crowd psychology is actually saying. So you are imitating, blindly imitating, actually following other people. This has been used to understand the financial markets, looking at the crowd in the trading outcry trading pit as a crowd, so that the traders would blindly follow one another, leading to bubbles and price moves. It's also been used by traders to, of course, trade in opposition to the crowd. So if you see a lot of people are doing something, you would trade against that and do the exact opposite. Someone like Humphrey Neal in the 1920s actually said that markets are in essence similar to the crowds described by crowd psychologists. They are characterized by fickleness, hysteria, and irrationality. And more recently, the economist Robert Shiller, who won the Nobel Prize 2 years ago, has said that mass psychology may well be the dominant cause of movements in the price of the aggregate stock market. And then, of course, the question is, how do we understand this in relationship to high-frequency trading? So what I'm looking at is how traders, they would actually make use of some implicit or explicit assumptions originating from crowd psychology when they are programming their algorithms and also when they are interacting in the trading room. So what I'm trying to give is an inside view of the trading room, following the traders while they are trading at their desk, interviewing them, trying to understand how they program their algorithms, how they monitor the algorithms, what kind of surveillance techniques are actually installed to program these algorithms. So I should probably add that this is quite different from financial economists, because they would normally take the data from the exchanges to look at how algorithms are actually interacting. So it would be a data-based approach where I'm actually looking inside the trading firm. So I stayed at a high-frequency trading prop shop close to Wall Street for 6 weeks, observing how they were working. And then, because I have data from one prop shop, and then I visited 6 other shops, I made use of interviews also with participants being active in the high-frequency trading space, just to get my observations confirmed from other people as well being active in this field. And I'm focusing specifically on US Treasury bond futures and index futures, because that was the products that was traded in the firm that I stayed at. And what they are doing is basically that they are buying and selling shares rapidly, as we also heard from the video. They are profiting from rebates, they are making use of market-making activities, short-term mispricings, and using statistical arbitrage opportunities. And well, they make use of low-latency strategies for data transmission. And I should probably add that the average holding time of a financial product is around 10 seconds. And the data transmission from issuing an order to the order being executed at the exchange is down to milliseconds and microseconds. So we are in the very, very fast high-frequency trading space here. And that leads me to the definition of high-frequency trading, because I think there's been a lot of misunderstandings about what is actually HFT, and it's been used as a general notion for automated trading. I would say it's a subfield of algorithmic or automated trading. So the Securities and Exchange Commission in the US, they are defining high-frequency trading as professional traders acting in a proprietary capacity that engages in strategies that generate a large number of trades on a daily basis. And so they are defining this in relationship to the firms that are actually executing these strategies. And then the US Commodity Futures Trading Commission, they have a bit of a different approach actually. So they define high-frequency trading more in relation to the actual technologies used. So just to sum up, they say that it is traders that make use of low-latency technology. They make use of co-location services to be as close to the exchange as possible to minimize response time, the time it takes to execute an order. And they make use of a very high message rates, orders, quotes, or cancellations that they send to the market. And then there's been quite, as we also heard yesterday, a debate about high-frequency trading. Does it actually provide liquidity because they are sending such a huge amount of orders to the market all the time? And I've quoted a lot of the financial economists who are actually studying this, and they point that to the fact that actually it does provide liquidity to the market. But then some people are saying, yeah, well it does, but it actually also withdraws liquidity under certain negative conditions. We saw an example of this yesterday. Richard showed us the flash crash, where high-frequency traders, they are there in the market to be on the other side of the trade all the time, so they make the markets work efficiently. But then we saw with the flash crash that actually, because someone issued a very, very big sell order, the algorithms would pick up on that sell order, the HFT algorithms, and they react to one another, so suddenly we saw this escalating price move. So, despite and across these debates whether high-frequency trading is good or bad for the market, one major concern remains, namely the rise of a new financial order that we see now. So, someone like Kirilenko and Andrew Lowe, they have written a paper that was also presented at the CFTC to the US regulators that the growing interconnectedness of financial markets and institutions has created a new form of accident, a systematic event where the system now exceeds beyond any single organization or markets. Because we see that high-frequency traders are trading across, they are making arbitrage across different products, which means that we see that the market are becoming more interconnected, and we also saw that with the flash crash because it started in the ETF and then it had spillover effects to other financial markets, and this is what someone like Kirilenko is quite concerned about. And then we have someone like Sonette and Susanne van der Becke, who are talking about this as well, but from a physicist perspective. They are saying that HFT stimulates the crowding of adaptive strategies that are pro-cyclical. As HFT use short-term information as well as adaptive algorithm, there is a potential for herding, as the strategies can crowd to the same signal, synchronize and lead to transient large instabilities. And again, they're using, of course, the flash press as an example. And this, within the psychological field, you would say that this is a strong form of contagion, because it replicates the idea that we see emerging behavior that are not rational, but that algorithms are actually responding to one another in, you could say, even in irrational ways, without the human intention or rationality of the human being programming the algorithms actually being aware of what is actually going on. Then we also see another kind of definition of contagion in the financial literature, which is that it's a natural consequence of market makers revising their orders in one market in response to changing liquidity conditions in related markets. So that is simply just a natural coincidence of actually traders making use of statistical arbitrage opportunities, which is a more light version that I will call a weak contagion. So in the empirical analysis, I'm going to quote a few of the traders that I interviewed to sort of show how that weak contagion is at stake in high-frequency trading, and then we might discuss how this leads to a kind of stronger forms of contagion. So here you see a quote from a high-frequency trader who is talking about that they are actually empirically measuring the correlation between different securities, and that they are making use of that. So instead of using contagion and crowd dynamics as something that might say that this is describing the current condition of high-frequency trading today, it's actually something that the traders, they use strategically in their strategies when they trade, which might not have that big consequences for the financial markets, in fact. So here there's a trader who also confirms this point about actually exploiting contagion in the markets. But I'm just going to jump so that we can get to the point about the more stronger forms of contagion, because this is an aggregated view of a high-frequency trader's black box. So what I did was that I asked traders to actually draw their black boxes to explain to me what they are actually doing, and to get a sense of how their algorithms are actually interacting, and whether we can detect what is actually the intention behind these algorithms, and are they intended or not to make use of adaptive feedback loops and to have this imitation behavior that is so characteristic of crowd dynamics. So just to explain, a trader would sit here uploading strategies to a platform. The strategies, that would be more than hundreds of these, would be loaded. It would specify the time and the size of a specific trading strategy, and then that would be loaded to an algorithm. I have categorized this into 3 types of algorithms. They would have maybe 20 of these running in average, the traders I talked to. I will explain in a minute what these algorithms are actually doing. So the algorithm would then send an order to a gateway, to an order manager that would aggregate all the different interests from the different strategies, depending on which exchange it's going to be sent to, because the exchanges, they have different protocols. So in the futures market, you would get executed faster if you have a large order. So it would aggregate all the different interests. So if some of the different algorithms would trade the same product, it would aggregate it, and it would send it to an order gateway, send the order to the exchange. Then the trader will know if that order was actually filled or rejected. If it's filled or rejected, that information is going back into a gateway, back to the order manager, back to the gateway again, and then back to an algorithm that would then reconfigure itself according to this information. So I assume that you now know where I'm getting at, because this is in fact a kind of adaptive feedback loop. So they are reading the order book, other traders' trading behavior, and they are issuing quotes in order to see how that would in fact change or impact the dynamic in the order book, and that information would then be sent back via all these steps in this adaptive way. And then I just wanted to explain what kind of strategies that I have seen that are actually being used in high-frequency trading. So the first one would be the spreader, which is trading US Treasury bonds against its corresponding future. So the US Treasury bond is traded in New York, and it has a 99% correlation to its future, which is traded in Chicago. Between this exchange from New York to Chicago, there's a 13 millisecond delay in the transmission of this data. So of course, if you are faster than this delay, if you have the traders I talked to have a connection that will be down to 8 milliseconds, you can of course detect that when the Treasury bond the price is changing in New York, you can buy up the future in Chicago at no risk, basically. And then there's another strategy called scalping, which is described, you might be aware of Michael Lewis's book about high-frequency trading. So this is more or less what he's actually describing, that you can send an order to an exchange. Then in the US, if there's a better price for the same financial product, it has to automatically be routed to another exchange that offers the better price. Again, if you're a high-frequency trader and you have a data transmission that's faster than the one between the exchanges, you can actually detect that the order is coming into exchange A, and then you can buy up that product at a cheaper price at exchange B, and then sell to the guy who just submitted that order. So that's one of the other strategies, and then there's the market maker. And so this is also to show that most of the high-frequency traders I talk to, they would be, normally we talk about high-frequency traders as being either market makers, the good guys, or maybe the scalper or the spreaders, the more aggressive ones, often portrayed as the bad guys. But I think the view is actually much more complicated, and I don't even want to say that the one is good or the other is bad. But also a lot of the traders, they would have different strategies working at the same time. And one algorithm would actually not live for very long. One strategy would work maybe 3 or 6 months, and then they would have to develop a new one. So this is a constant and dynamic system where they would develop algorithms all the time. So now you can also see where I'm going with this, that actually the human has still quite a huge space in this, developing the algorithms, because it's a dynamic process and the algorithms would need constant care, monitoring and so on. So the high-frequency traders would also be quite emotionally attached to the algorithms, and some would tell me stories that they would actually have a tendency maybe to let an algorithm run for a bit longer than it was supposed to, just because that they would believe that it would earn money at some point. Which is also dynamics quite similar to what we saw before, when traders, they were affecting one another in the open outcry pit. Now we just have another mediator, and that's of course the algorithms. But technology is definitely, to my mind, not something that would eliminate human biases in the trading field. So just to conclude and then sort of pose some questions for debate. I would argue that in this way we can see the contagious dynamics. I wouldn't say that it's bad or it's good. Unfortunately, contagion has had in the financial literature quite a negative connotation. It does not have that negative connotation in sociology. So from a sociological point of view, I'm interested in looking at how the psychology of trading is changing. Because we see these imitative dynamics without a human intention behind it necessarily. It's algorithms reacting to other algorithms. And it's actually quite difficult to say whether that is intentional, whether there's intention behind the way that these algorithms actually react to one another. So I think the main question is then, can we actually hold individuals accountable for what are, to my mind, systematic properties and risks? So when we see, for instance, the flash crash, there's been one guy now in London charged of actually having caused the flash crash. To my mind, that story seems quite unlikely actually, because the flash crash happened because of the interaction between algorithms. It's a systematic feature of the financial markets, and I think the notion of holding an individual accountable is a problem, and I think it's because within the juridical system you need to have a subject that you can actually hold accountable. A bit like in traditional psychology, you need an individual with a conscious mind. But if you look at this from a more sociological or social psychological perspective, it looks quite different. And I think we have to rethink the way that we conceptualize the consequences of high-frequency trading in relation to these more interactive dynamics. Yeah, that was my sort of comments on high-frequency trading. Thank you.
but you'd better take the orange one.
Yes, it has the orange pen. It's much better. So I don't really have any presentation, and was more prepared for discussion. But there's one thing I wanted to say just about this. I found it very interesting that you mentioned that before the traders, they used to sit in one room and they used to react to each other. And now sometimes I think it's not the algorithms reacting to each other. It's the algorithms being trained on the same data set. They just react to similar patterns. Because when you develop an algorithm, what happens? You have a certain set of data, and in that data you have different prices, and basically you try to come up with some algorithms, something that will detect some patterns there, and that will try to predict the prices. So suppose that we have a bunch of firms that have such algorithms on one market, and they use the same data set. So in that data set they found some patterns and they try to predict the price, right? And what happens then? Suppose that we have a certain price curve that looks like this in the real market. And the thing is that at this point, well, better at this point, if we come to this point, we'll have a bunch of algorithms that will try to predict the market. And if they were trained on the same data set, even though there are different algorithms, they look at different parameters, they look at different alphas. If all of them, well, I mean the majority of them, decide that the price is going to go there just because previously such pattern led to the price going up, what would happen? They won't react to each other. They will just react to what was in the data set before. They will think, all right, the price will go up. I don't want to be a market maker here. I want to get the large position. I want to unwind my short position, and they will do it not because they react to each other, but just because they were trained on the same data set. And so what would happen? Perhaps this scenario would happen because they will start buying because they were trained, and they will push the price up. And what will happen during the next recalibration? In a week time, in a month time, this thing is going to go to the data set, and it will make this pattern stronger, just because there was another occurrence of such pattern. And they will be even better trained for this pattern, so the next time such pattern appears, they will buy more aggressively, and more aggressively, and more aggressively. So it's not just algorithms reacting to each other, it's more like algorithms reacting to previous instances of algorithms that are in our data set. I find it very interesting, and I find it hard to mitigate in a way, hard to stabilize. Because the thing is, even if you're, because of some ethical concerns, want to stabilize the market, you have some machine learning algorithm, and you have the huge data set, and you ask the algorithm to maximize your profit. Well, you can minimize the volatility of that profit, you can put all sorts of things, but eventually there will be some process that will try to find the pattern here, and it will tell that you should buy here just because the price is going to go up. So, I'm not sure.
Can I comment? What I've seen in the field, so this is only what I've seen, of course. Can you hear what I'm saying? So yeah, this is just based on my observations. And you know this field a lot more inside and a lot more about the data than I do. But what I was told by some of the traders I talked to, the one running the firms, is that we have like a continuum of different HFT strategies where we would have the fastest guys here, and it would actually not do that much with data because it takes too long for the algorithms to actually process the data. So if you are in the very, very fast HFT space, you wouldn't really do a lot of backtesting and so on because you would respond in real time to price moves also in the order book. And I think here we can talk about like an interaction order perhaps of algorithms, but then we have the other space, which, I mean, it would still be within the HFT space, but it would be people employing slower strategies and smarter strategies. So they would not only be competing for speed, but also actually trying to compete by having a different strategy than others. Or seeing something that others they don't see, and do quite sophisticated data mining processes and looking for patterns and so on. And these would also employ a different kind of trader type. So these people would be very, in the fast space, they would be very good with programming, very practically based, also having engineering skills. Where here they would be quite sophisticated math people and physicists and so on. The really hardcore quant stuff, I think, is here. So I think maybe this is where we see the differences, right? That because we can talk about this as a continuum of different HFT practices. So I guess what you're saying is actually adding quite an important perspective that if everyone's reacting to the same data, we also then might see some effects on price moves. Yeah.
Yes, and in a way, the better algorithms become, the more they converge to each other, right? Because if you get closer to the perfect prediction, different firms get closer to the perfect prediction, it means that they're going to get the same results more often, and they're going to augment the behavior. So it's a big question of how to stabilize the market, considering that you have all those algorithms just trained on the same data set.
Can we ask questions? Yeah, just maybe question to you.
When the reversal is to start, yes, they are trading on the same data, but sometimes the bubble is to be burned. Sometimes the reversal has to happen. What should be the trigger?
You mean that the price can't go up forever?
Yes, so sometimes it will reverse, the trend will change. But what will be the trigger for this?
Oh, I don't know, some patterns, something. I mean, fundamentally, it's a question of beliefs, and it's a question of risk management in a way. What would happen if it's going to go to risk management? So basically, all the firms will max out in their positions and start to unwind, where there's going to be a pattern. And again, the algorithms will find something similar to historical data that will tell them that it's going to go down, and they will start unwinding, making it a self-fulfilling prophecy. And here I'm not talking about the news, because there's some news feed, there's some traders, there's some executional risk. Again, I was just talking about the pure high-frequency dynamics.
Thank you. As far as I understood, Anne-Christina describes the crowd dynamics where the individual forces are mostly melted, and the behavior of the individuals is unified and converged to some one common strategy. But my approach about behavior was more about individualistic things. At the first school, I presented the approach based on the transactional analysis. This is the theory of Eric Berne. And it has many components about interactions between individuals. But one of them I would like to emphasize now, to remember, is so-called the script or life scenario. The script is partly unconscious pattern to which the life of the individual is broadly structured. Why I remembered about this now? Because before I have read the article of Anne-Christina, another one article which Sergey had sent to me a few months ago in connection to one other project with Alexei Sakunin, who will present now. And as far as I understood your article, Markets, Bodies and Rhythms is about rhythm analysis. and about the significance of bodily feelings, which is present in the individual behavior of traders. And there is even a fundamental approach called as rhythm analysis about putting the rhythm of some processes, some natural things, into their consideration. And as far as I understood, you emphasize the importance of bodily feeling, of bodily awareness of market participants, at least, and the importance to investigate their behavior. And I think this subject is mostly often missed, even in psychological analysis of things. But it is really extremely important. Our bodily awareness and the participation of body in reactions and in mental calculation and the, so to speak, some subconscious calculations that traders perform based on all the environment around. And perhaps they use the approach the same as the ancient hunters or other people who were involved in some natural environment could use to react to many stimuli which are concurrent and controversial and which are extremely difficult to analyze by the superficial level of consciousness. And I think even with modern data science algorithms as well, there is a huge level of unconsciousness, which is grounded in nervous system, in bodily processes. And as far as I understood, the traders calibrate their bodies to the all market signals. You talk about open outcry market, to the physical noise, gestures, and so on. And they perform that kind of mental calculation about the behavior of markets, about the rhythm of market, just based on this very ancient system of human organism. And I think this is very interesting direction for further research. And the rhythm is something natural, something cyclical, something that has several distinctive stages like birth, growth, and decline. And so does human life script. It also can be described as rhythm, because script is a structure like myth, it has its own beginning, it has its own drama, and some outcome. And perhaps the principles of rhythm analysis can be applied to scenario analysis of the whole human life as well. And also I have heard your interview, on the YouTube with two traders.
Yeah.
You were not aware of this?
Not really, actually. I use publicly, but I don't think it's something that people actually do.
As well, maybe there's going to be some secrets.
No, they talk about what drives them into market. You interview, this is quite a long interview about the drives. And for me, it was always the question what is really interesting about financial markets, and what I took from that interview. They have said that it gives the perfect freedom. It gives the ability to apply their talents directly in the most direct way. And I felt that financial markets for such a people is like an element, is like a complete chaos. And it is perhaps like surfing or climbing something to be immersed and involved in the great broad chaos, and it gives people some existential feeling. What? Yes.
Yeah, then
Okay. Yeah. No. So I just wanted to add a comment about what you said about also the unconscious and the bodily immersion, because now I just said that, well, we are talking about a kind of psychology where the individual and the human being are actually not that present. But I mean, the interview you referred to, and also that article, is actually looking a bit more into the organizational structure of these firms. And of course, there are something to be said about the self-perception of being a trader. What does it actually mean to perceive of yourself as a trader? What kind of self-identity is actually at stake in that? Where I guess that individual psychology might be at stake still, but I guess it's not at stake in relation to talking about the interaction of algorithms. But of course, you can still say that there's a human behind the algorithms, and yeah, it would be interesting, I think. But I'm not trained as a psychologist, but it would be interesting to hear a bit more about how the more traditional psychologists like yourself would actually approach this.
About my approach?
No, I would do after it at all. They would answer this comment first.
Perhaps I think some.
Yeah, just I wanted to add one thing. That there is some psychology even if you are pure quant. Basically, when you construct the model, it's all about the data, and you load some data, you apply some analysis, you come up with the algorithm, you test it, and then it works for a while, and at some point you see a 2 standard deviation, and then you have to question what to do with it. So probably it tells you that it's outside your model. It's not something that you expected, but still you have the question whether you want to continue with the algorithm and whether you should stop it. So you can say that, all right, it's not something expected and it won't work exactly as expected, but you don't have any other algorithm at this point. And perhaps if the market has changed, you don't have enough data to recalibrate it. So you have to make a decision whether you think that in the current environment it's going to have maybe higher volatility, maybe it's going to be more risky, but still it's going to be good enough algorithm so you can continue with it until you accumulate enough data, or that the standard deviation move is a sign that it won't, it's not just the risk, it's the shift in the mean, it's the shift in profits as well, and you have to stop it. And there is some psychology, and there you'll have something like trust in the algorithm, something that you can't really quantify because you don't have enough data to test it. And you have to make a decision, and it's going to be a discretionary decision even in the highly quantitative environment. Even if you think about the ultra HFT firm where you don't make a direct decision on trades. That's...
Can I add to that? Yeah, I mean, just another story from the field. I've seen traders actually arguing about this. So, like, one trader wanted his algorithm to actually run for longer, and then the programmer said it should stop now because it's not earning money. And then in the end, you have to make that debate, right? And you have to battle that. And that is, of course, also something that is highly, I think, psychological, that you have to, you're emotionally attached to it, and then someone else is maybe not as attached and then want to stop it, and which might create some conflicts and debates, yeah. And also we discussed just before the organizational structure of these firms that would also be quite, well, from my experience, quite different. So in the very fast HFT guys, the code would be very short. So, I mean, I would not, that's probably also why people, they allow me into these firms, because I don't understand the coding and they know that I don't understand. So there's no way I can take it and do something with it. So I simply don't have the skills. But if someone would know about coding, they could actually memorize the codes because they are that short. So these firms would be divided, and within teams you would not even know the overall specific properties of the whole coding system, so you would only know the part that you are working on, so that is highly secret. And I think to talk about sociality in these firms is actually difficult, because it is so divided and more, yeah. And then you have the slower HFT guys with the more advanced strategies, and here they don't need to be so secret, and they can actually collaborate a bit more. And here we can definitely talk about psychology. I mean, I talked to a head of a trading firm who would divide his traders, not because of being afraid of the codes being stolen, but actually because he was afraid that his HFT guys would start imitating one another and be affected by one another, and they would then suddenly all do the same strategies, and then they would not have a diversified risk portfolio. So it's also a pragmatic issue actually to think about and take care of these psychological matters within trading firms.
Yeah, if you divide, you have that false sense of security that you are diversified, which is not necessarily true.
Okay.
Because what I mentioned, if you have certain data and certain patterns in the data, there are many different approaches how to find them, and you can have the impression that you have different teams working on completely different approaches. One is using one machine learning algorithm, the other is using another, the third one is using some very complicated statistics and so on, but eventually if they might come up to the algorithms that make similar decisions, similar situations, just because according to the data it was optimal to make such decisions. And you think that you are well diversified, and if you look at the market as a whole, you can say that the tens or the hundreds of different algorithms, probably they will do something, and then you see the flash crash just because partly they react to the same signal, the same way, just because it was optimal. So, yeah, in some firms, it might be a good idea to split the firm, to have different teams, but you should be really careful, and sometimes it gives you just a false sense of security. And it applies to low frequency as well, because the low frequency, before 2007, you had lots of low frequency funds, and they were arguing that they have such cool strategies, they have cool models, but in the summer 2007, there was a big sell-off in the sort of quantitative portfolio. They realized that they were concentrated in pretty much the same names, with all their strategies, with all their different approaches, with all their different superscript alphas. They were still buying very similar names, so when there was an unwind of a large subset of that portfolio, they all were hit, and by seeing, and they started to unwind as well, and we had several days with several standard deviation moves each day, something that shouldn't happen in this universe if you assume that you were diversified. It happened.
Actually, I want to ask you another question. It's so amazing to have a high-frequency trader. Did you actually experience the flash crash? And what was your experience?
Do you mind if I answer it without the camera after?
So it's just.
I'm happy to share some sort of general things and general views, but I don't think that I can.
But I was more thinking about the feeling or the way you
Oh, the feeling.
I mean, not the...
Yeah, actually, it was very interesting because we were having a dinner, and there were a few high-frequency traders, so that it was the meetup of the school I graduated from, and it was very interesting. You could see who is the high-frequency trader just because they immediately started looking at the Blackberries, they started opening their laptops, and it was funny. It was a very interesting experience. That evening was a very interesting experience, that's for sure.
Because I'm also just linking it back to what you said about the bodily immersion in this, because I saw, it's probably also at the same link as the interview I did, there's a guy describing the flash crash and his experience of it, and he's just sitting there being like, suddenly it goes black, the market is gone, it's gone, it's gone, it's black, and it has that kind of really, now the world has gone crazy and everything is destroyed, so it shows that kind of real bodily immersion into the field where the market is what you are actually following and you are so attached to it that when the market is gone, I mean, other people might not even have noticed, or if you went to the bathroom, it took like, what, 10 minutes, 15 minutes or something? You might not even have noticed, but for these traders it was really a hardcore experience, and to a very existential extent that some people, they actually resigned afterwards because they realized how fragile the market are in this moment.
Yeah, but it's also about the priorities. So we had the guys and we had the dinner, and you know, we had a nice dinner and we finished it with some drinks and we just relaxed because perhaps the school meetup is more important than the flash crash. So you should just have your priorities right.
This one is the orange band.
Hi everybody, my name is Dima. I don't know if you know me, but I work with Richard. So my question is a bit from the ethical side, so I would appreciate if you can share your thoughts, guys, in the panels. Are HFT the good guys, providing liquidity to the markets and helping efficiency? Or are they the villains, taking advantage of the little people? I will appreciate all your answers.
What's about the good guys? No, but seriously, I think that while in general HFT can introduce some very scary dynamics, they're not really preying on little people. They're more like they're taking their share from banks. Because before the HFT revolution, before lots of firms came to the market to provide liquidity to stabilize the market, they were just big banks. And if you look at the spreads, and if you look at the market impact, and if you look at the trading costs for the long-term investors, I would say, they went down quite a lot because of the HFT, because the markets became more open, because it's more competition there. So, yes, you can make money by providing liquidity, by staying passively and just staying there with your orders, or you can make money by scalping, by buying something. But in the first case, when you provide the liquidity, all right, you provide the liquidity in the right way. And if you do it aggressively, you usually stabilize the market, because otherwise it will perhaps, well, I would say that otherwise the total cost for you would be probably higher. You will have less liquidity and it will evaporate faster if you just trade with the bank. You can look at the numbers. Again, it's hard to compare the 90s and the 90s and what we have now, but still, if you look at the aggregate numbers, trading costs went down with the large orders. So that's my view.
I mean, I would also say no, actually, that the HFT guys are not the bad guys, but I think we have a wrong system, and I think it's the market design, the market microstructure and the market design that's wrong, that something like the flash crash can actually happen. But I think that story also needs to be complicated a little bit because the flash crash cannot happen today actually. And I think also it's a bit of an exaggeration the way that people they use the flash crash to talk about the danger of HFT. Because now exchanges are having introduced circuit breakers, which means that algorithms cannot go crazy in this way. They will actually stop them from working. And so I think it's a matter of actually regulating this market, not necessarily to eliminate the HFT guys as such, but just to make sure that these crashes and these dangerous events cannot happen. But then, so last year, in October 2014, we actually saw another crash. And we have seen that people are, the financial economists, they are actually detecting that mini crashes are happening all the time. And no one really knows whether we are safe or not, that it can happen again or not, for different reasons. But now in Europe, the method are being updated in 2017, which means that the HFTs are actually, they should be registered and have a license to be acting as HFTs. So that will limit that they and make sure that they have the capacity in the firms, that the guys actually they know what they are doing and they have the right skills to actually be able to program the algorithms in the right way. Yeah, so there are some circumstances that are being put into place. I think that so I don't think we should blame the guys. I think we should maybe blame the system. Yeah.
Maybe just.
So, speaking of our discussions about HFT good or bad, let's try to see to this question with another side. So there is a good sentence that HFT is holy grail of financial market. So from the view of the HFT, is it good or bad? So I mean, what do you think? Is it really HFT strategies which we can't lose from markets and earn the profit all the days in the market, or it is the risky strategy and
Protocol trading?
yes.
So,
But they're just different strategies, and for quant, you can find interesting things in both types of strategies. And HFT is more data. You can run some funny algorithms that you can't find in low-frequency environment just because you don't have enough data. I mean, it's hard to compare. I would say that all of them are interesting. You can find something interesting there. Just one quick thing with the flash crash. I just want to know that. You can have such events even without HFT. With HFT, it's going to be really fast. That's true, and it's going to be really dramatic. But it's going to be dramatic on a 15-minute scale. While with the low frequency, you have the Lehman crisis, which is much bigger crisis than a flash crash, and it was done without any high frequency at all, pretty much. It was done with all the counter things, and I think it affected trading, it affected the world, it affected everything much more than all the flash crashes combined. Or you can consider the Volkswagen, the situation when there was a short squeeze just because some discretionary traders decided they can go short and they went massively short, and then at some point there were not enough shares to cover their shorts. So for a day, Volkswagen became the most expensive company in the world. It was when the Porsche tried to do the takeover of Volkswagen, and it's again something done by the high-frequency traders, and it wasn't, in a way, I think it was a bit more dangerous and a bit more dramatic, but you can't write some articles about the Volkswagen. Well, you can write, but if you say that there are lots of robots doing something on a 10-minute scale, and those articles will gain more attention than if you say that, some discretionary traders, they just miscalculated and there was a short squeeze and Volkswagen was the most expensive company. Alright, it's not really a story, as opposed to the flash crash, which was a story. So you can have much bigger crashes without that HFT.
So I think another ethical issue is also, you might disagree with me on this, but that HFT are actually able to make a risk-free profit. And then they argue that it's a different kind of risk that they take, which is the investments in technology and so on, which is also a risk. But in a way, it's not a financial risk. And this has been a big argument against HFT practices. But also, I would say again now, so well, HFT, they may provide a service to the financial markets, but they also earn a risk-free profit. So in a way, if we allow them to earn a risk-free profit, shouldn't they actually provide like another service? And back in the days when traders were acting as a designated market makers at the exchange, they were actually supposed to also take a loss to make sure that the buyer and the seller always meet. Now we see that HFTs are not acting as designated market makers, which means that they are not forced to take a loss. So with the flash crash, they would not be buying when everyone else is selling, for instance, preventing these moves. But now with the updated method, I believe, I'm not totally sure about this, but I think that the HFTs are also supposed to be designated market makers, and I think this really makes a difference, because then they would also need to take a loss, and they would actually provide a service to the financial markets and increase the stability of the financial markets, and then I think it's fine that they take a risk-free profit. So I think this is also a debatable issue. Yeah?
Yeah, it's a very good question, whether you should not consider HFT the proper financial company managing money, or just a technological startup, because HFT is not really managing money, and the risks with HFT are not the financial risk for holding a big position, but the risk of that your costs are going to be more than your profits, that you won't be able to return. I mean, there are lots of companies that make money without taking the financial risk. They make money, but it's not really fully risk-free. And especially in the last few years, a long list of HFT companies that left the market just because the costs were higher than their profits was the usual risk. But it's a good question. It's a good question.
My question is, could you please classify fields or spheres where HFT is a must and a necessity to be successful?
You mean in which markets?
No, I mean the approach. You said the past guys, yes, the trading patterns or market makers. I mean in this classification where HFT is a necessity.
Well, but I think in any market, well, in many markets you can have profitable HFT firms. But pretty much in any market you can have profitable firms that don't rely on such patterns, that don't rely on HFT at all. Was that your question?
No.
Sorry.
My point of view, for instance, in Russian stock market or futures market, if you want to be a market maker without HFT, it's practically impossible.
Oh, being a market maker?
Without. Yes.
Well, if you want to become a market maker in something which is traded on the exchange, you need to optimize your infrastructure, that's for sure.
Yes.
Pretty much on any exchange.
If you're trading fast scalping strategies, HFT is also a dominant strategy right now, dominant approach. Do you agree?
Well, HFT for me is basically something, well, it's not just an approach, it's just the fact that at some point you realize that your cycle measures in microseconds and you optimize the connections, all that, and then you become the HFT. And yes, scalping and HFT is in the way. You can't do scalping if you are slow just because someone is going to do it faster. So you have to optimize at some point. With over-the-counter products, I guess it's not really possible. There might be some exchanges that don't require such optimization because of their infrastructure. Some exchanges, they might have really slow infrastructure, really random infrastructure, but all the developed exchanges, they have good enough infrastructure. And finally, it's another thing. There's a very hot topic now to stop that race, to stop that speed race, and to, as I said yesterday, to switch to a system of auctions that will, in a way, eliminate the need for the microsecond optimization. But I guess, unfortunately, this is not the case with major exchanges yet. So if you want to do the scalping, if you want to make profits on ticks, you have to optimize the infrastructure and get the HFT space, I guess.
Is the speed limit reached right now in HFT?
Speed? No, I don't think so, because, well, again, it depends. I don't have the full knowledge, but still, you have your network card, which is usually separate from the CPU, which might be separate from your calculator, whether you use the GPU or the special chip. So eventually, you might end up with something that combines the network card, the CPU core, and the reprogrammable core. Then it's going to get faster. Then with the communication, there was a big switch from the optics to microwave, just because in optics and fiber optics, the speed of light is about 2/3 of the speed of light in vacuum or in air. It was a big change, but not all the links are there yet. Yeah, and all the transatlantic links, there are still optics. There was some, a couple of years ago, there were some crazy projects with the balloons providing microwaves, but they're not there yet. And it's not a thing. A couple of years ago, the HFT market was making times more money than it's making now. So such projects were visioned and people were thinking about doing this. I don't think that now people are considering such ideas. They can be too capital intensive.
Okay, can I add about HFT good or bad, my point of view? Actually, I think HFT traders, they're not good, not bad, they're just smart. Personally, my experience, when I trade futures during daytime, if I buy and the seller is HFT, normally I lose money. So that's why I don't like HFT technology. But sometimes I buy from HFT sellers and still earn money. And the HFT technologies try to cut the losses as soon as possible. So, and you say HFT technologies and market makers provide liquidity. Actually, it's not that true, because if the market is going against HFT traders, they don't want to take big positions, and they just, it's like a false liquidity. They show offers or bids, but if the situation is getting hard, yes, they take these limits from the market.
Yeah, they don't always provide the liquidity, especially when the price goes against. But the fact that you bought from HFT, it just meant that it was closer to, it was inside the spread compared to a bank, which meant that you paid the lower price to HFT as opposed to the bank staying somewhere deep in the book. That's what I meant. So without the HFT, you would just go deeper into the book and buy from an institution there.
Yes, and a few words about flash crash. I think it's a payback time for HFT. That's it.
Thank you. And very interesting topic for research for academia.
Few questions for you. Is it HFT is successful? Is it about mostly to be the fastest in the market, or it is about to be the smartest guy in the market? And next question. Is it about HFT successful also? Is it about prediction of future price, or is it about knowing the microstructure of market and know the supply and how behavior of the process of supply and demand in the market?
Well, I'll start with the first one. There are different ways of making money with HFT, I guess. So if you have the fastest link between two exchanges, then you're going to make money because you're the fastest one. But if you have a good enough alpha, you still have to be the fastest. Well, not the fastest, but fast enough, because otherwise consider that you have the perfect alpha, but there are 5 other people and each one has 20% of your alpha. And if you're slow, you always know where the market is going to go. And each of them know just 20% of the time. If they are faster, then they will always get that order instead of you. So, in a way, you got to be smart, and being fast enough is a prerequisite for being in the space, because otherwise, even if you're smart, you won't be able to realize profits, you won't be able to make a trade. And the second question, well, it's really connected. So, the way I see it, how it works, you just try to find some signals, you try to find some alphas. Some of them come from the microstructures, some of them come from, from some data. Again, it's, you look at the market and sometimes you look at the order book, sometimes you look at the time, sometimes you look both at the time and at the order book depth, sometimes you look at the trade, sometimes you look at different markets, and then you come up with a set of signals, and then you have some optimization method, machine learning is a very broad word, but some method that will try to find which signals are good and try to calibrate it. So it's a combination, I guess. You look at everything and then the machine decides what to do. No idea. Sure. Answer the question.